What's up, guys? I'm Nobody Special, and today interest rates were all the rage on financial press. Everybody's talking about how interest rates on the benchmark 10-year Treasury have been in free fall this week, dropping all the way from 1.44% at the beginning of the week down to 1.28% as of the making of this video. Now, I can't tell you exactly what's going on in the bond market, but I can tell you exactly when it started, and knowing that, we might be able to guess where it's going and how long it's going to last. You ready? Hit it. Thanks for joining me. I'm Jack Gamble, and I'm Nobody Special. And the bond market is trying to tell us something right now. Now, I don't know exactly what the bond market is telling us and what it means, but I can tell you exactly when it started, to a day. Now, the talking heads in financial media are saying, oh, it could have something to do with stocks being overvalued, or it could be a cyclical rotation back into big tech from, the inflation trade, or they're saying this marks the end of the reflation trade, or it has to do with the recovery. All this litany of reasons are being cited for the reason why interest rates on the 10-year are dropping, especially considering it was only 2 weeks ago that the Fed told us they were going to start hiking soon. So you would think interest rates would start to climb to front run those anticipated rate hikes. But as we've seen, the opposite has happened. Now, I want to be careful here because I don't want to pass myself off as an expert. I'm not the kind of guy who can read the tea leaves in the bond market and tell you exactly what is about to happen. Okay? But there are some very potent data points hiding in these charts that tell us exactly when it started, and then we can go look at what happened on those days, and then we can kind of start to figure out what's going on. Now, if you look at the chart of the yield on the 10-year Treasury bond, you can see we're in a pretty clear downtrend from what looks like a double top that was put in back in March. And if you look closely, you can see the first of those peaks was around March 18th, and the second was around March 31st. Now, what's significant about those 2 days, you might be asking? Well, March 19th was the day the Federal Reserve announced that they were not going to be extending the exemption for the supplementary leverage ratio, or the SLR. And then May 31st was the day the SLR exemption actually expired. So what we've got here is a double top in 10-year yields when the Fed says it's going to expire and when it actually expires. Now, again, the supplementary leverage ratio, we talked about this in the last video. This is the rule that says the banks need to keep so much collateral on their books as a percentage of the amount of deposits that they have. Remember, our money is liabilities for the banks, and they need to have treasuries to act as collateral for our money. Now, you can see the same thing on the chart of TLT, which is kind of the inverse. This is the price of these long-term bonds. And you see right here on March 18th, there is a pretty clear V bottom put in. This is right before the Fed announced that the SLR exemption was going to expire. And those bonds have been going up ever since. Now, another story that's been getting a lot of headlines has been this situation with the reverse repo markets, where the banks have so much cash on hand on their books and they don't have enough collateral, and they're being forced to make these big loans back to the Federal Reserve. Well, if we look at the chart of the reverse repos on a daily basis going back to March, you can see right here, March 18th, is the first time we saw these reverse repos pop up and stay up. And then again, March 31st, look at that spike. Now, that's a bigger spike on March 31st because that's the end of the quarter. You would expect more money changing hands around there. But again, you've got these two dates around March 18th, 19th, and then March 31st, the end of the quarter. You've got two very pronounced moves in reverse repos. And you'll notice these reverse repos have continued to increase on a daily basis ever since. Again, you've got that big spike there at the end of June. That's an end of the quarter, so you'd expect that. And it came down and corrected, but we're still moving up. These reverse repos are moving in tandem with the yields on the 10-year bond. Now, looking at all these data points, again, I can't tell you exactly what is happening in the bond market. And I can't tell you what it really means overall for the total economy. But I can tell you that this started with the announcement of the SLR expiration and with the actual expiration. This began, not clear as day. This started when they announced and when it expired. You cannot deny that correlation. So what does that mean? That means this move in interest rates has less to do with stock prices, has less to do with the strength of the dollar or with institutional investors or what pensions are doing. This has to do with monetary policy and the mechanics of the banking system. That's why these interest rates are dropping. It's the only conclusion I can draw looking at these data points. And when I go back to those 2 days, March 19th and March 31st, I see all of these trends starting right on those 2 days. Now, if you've been following me since my Reddit days, you know I'm very much into precious metals, and particularly silver, and to a lesser extent gold. And I've been scratching my head recently wondering why gold and silver aren't rallying as these interest rates have been dropping. That didn't make sense to me, especially when you look at real yields. Real yields is the interest rates on bonds minus inflation. And if you look at real yields, in the case of this chart, we're looking at 10-year Treasury inflation-protected securities. If you look at these yields, you can see very clearly, again, March 18th, March 19th, look at that top, and they've been coming down ever since. Now, gold and silver are supposed to trade inversely with real yields. As real yields drop, gold and silver should be rising. Now, I thought they weren't until I looked a little closer at the chart. Here's a chart of gold going back since the start of the year. And what do we see? Pretty clearly there on March 31st. Look at that bottom it put in. And it's been rising pretty steadily ever since. Now, we're all familiar with that big gold price smash that happened when the Federal Reserve announced they're talking about a few weeks ago. But if you'll notice and you look close enough, you'll see that overall uptrend is still intact. And of course, that big sell-off was not justified because yields have continued to drop. Real yields have gone further and further into negative territory. So, okay, let's look at silver too, my favorite of the shiny metals. And again, you look at the silver chart, look at that bottom right there on March 31st, clear as day. Now, again, you've got that big price smash in the middle of June after the Fed meeting. Now, that big sell-off in June must correct. I want to emphasize that. It has to correct. It was market manipulation, and it was not supported by any of the fundamentals. And the laws of economics do not cease to exist here. So where am I going with all this? A couple of things. We talked about in the last video that a lot of this spending and a lot of what's going on with the 10-year and everything has a lot to do with the Treasury General Account and the government spending down money that it printed last year without borrowing anything from the economy. And we talked about in that last video, I'll post a link in the description, how there's still money left in that TGA account. And it's going to take a couple of weeks, maybe a couple more months to get through it before they start issuing more bonds to borrow more money. So this trend we're seeing in interest rates and this trend we're seeing in precious metals should continue for at least a couple more months. And if you factor in that this price smash in gold and silver back in the middle of June was totally unwarranted and unjustified, and that the market fundamentals and the natural buoyancy of gold and silver prices in a declining yield environment, then we should see a very nice rally in gold and silver over the next few months. Now, you always have to factor in that precious metal markets are so heavily manipulated, and don't ever underestimate just the depths of depravity that these market manipulators will sink to. But the fact is, the fundamental case, there is a huge amount of buoyancy beneath gold and silver prices right now. And just because they smashed that price down in June does not mean market fundamentals change. It does not change the laws of economics. Those gold and silver prices are going to want to come up as long as these bond yields continue declining. And if you look at the Treasury General Account, you can tell that the bond yields are going to keep declining for at least a few more months. Guys, I want to thank you for your time. I hope you enjoyed this video. If you did, please give me a thumbs up and subscribe to my channel. It would really help me out. In the meantime, live small and dream big.